Welcome to the deep dive. Today we're really zeroing in on HDFC Bank, specifically their Q4 results for the financial year 2025.
Yeah, we've got a good pile of material here. Earnings call transcripts, presentations, result highlights, the works.
Exactly. And our mission, as always, is to cut through the noise, distill what really matters, and give you a clear picture of, their performance and where they might be heading.
Think of it as us doing the heavy lifting, pulling out the key insights on one of India's biggest banks. We'll unpack the numbers and the story behind them.
Right. Now, before we jump into the real nitty-gritty financials, it's probably good to get a sense of the backdrop, the context.
Definitely. The bank's leadership seems, well, pretty positive about the Indian economy overall.
They're pointing to things like potential RBI rate cuts, inflation cooling down a bit,
Yeah.
seeing those as supports for GDP growth in FY26.
Exactly. They reckon growth will come from more rural spending, solid consumer demand, and investment picking up.
But they're not ignoring the global picture either.
No, not at all. They're quite clear about the, uncertainties out there. Trade tariffs, global macro stuff. It's making some businesses maybe hold back a bit, adopt a wait and see.
Okay, so that's the environment. Strategically, what's the focus for HDFC Bank right now? Still that post-merger integration.
Yeah, that continues. A big piece is still getting that credit to deposit ratio down, the CD ratio.
Right. Lowering that and keeping costs under control.
Precisely. Tight cost control. And they keep highlighting asset quality as a real strength.
And those tech investments we've heard about.
They expect those to start bearing fruit, but gradually. Not an overnight thing.
Okay, makes sense. Shall we dig into the actual numbers then? Maybe start with the standalone figures for the bank itself?
Sounds like a plan. Let's kick off with net interest income, NII.
Okay, so NII. Looks like it grew 10.3% compared to the same time last year, reaching $320.7 billion.
Yeah, pretty healthy growth. And what supported that was stable cost of funds around 4.9% and a steady yield on their assets, about 8.4%.
That stable cost of funds is interesting. How they manage that?
Well, a key factor was reducing their reliance on borrowings. That mix has shifted quite a bit.
Oh, yeah. How much?
Borrowings were down to just 14% of total liabilities in March this year. Compare that to 18% a year ago, or even 21% back in December 2023.
Wow, that's a significant shift. So less borrowing really helped keep funding costs in check.
Definitely played a big part. Okay, so moving on from NII, net revenue.
Right, net revenue. The figure is $440.9 billion for the quarter. Now, that looks lower than the euro $472.4 billion from Q4 last year.
But there's a big asterisk there, isn't there?
Exactly. Last year's number included that huge euro 73.4 billion gain from selling their stake in HDFC Credila.
Right, the Credila sale. So if you strip that out, the picture changes.
Completely. Adjusting for that one-off, the underlying net revenue actually grew. And their other income, again adjusted for Credila, was up about 10% year on year.
So important context there. You got to look past the headline number sometimes. What about the bottom line? Profit after tax, PAT.
PAT saw growth too, up 6.7% year on year, hitting $176.2 billion.
Okay, solid growth. And drilling down a bit into profitability metrics. Net interest margin, NIM.
NIM came in at 3.54% on total assets. It was a bit higher, 3.73% on interest-earning assets specifically.
And they often talk about a core IM too.
They do. If you exclude the interest they got on an income tax refund, the core NIM was 3.46%.
What's really striking, though, is how stable that NIM has been.
Yeah, they mentioned it's basically operating in a very tight range, like 3.4% to 3.5% for the whole past year.
Which in a fluctuating rate environment is quite something. Suggests pretty good control over both sides, funding costs and asset yield.
Absolutely. Gives a sense of predictability, maybe.
Mm-hmm.
Okay, what about their lending, the loan book?
Right, loans. Gross advances hit $26,435 billion. That's up 5.4% year on year.
Just 5.4%. Seems a bit lower than maybe expected.
Well, there's a story within that number. Retail loans actually grew faster by 9.0%.
Okay. So what dragged down the overall number?
Corporate and other wholesale loans, they actually decreased by 3.6%.
Decreased. Was that intentional?
Seems so. Management specifically said they consciously slowed growth there. It was about positioning the balance sheet.
Okay. Slowing corporate lending to manage the balance sheet. Interesting trade-off. Let's flip to the other side, deposits. How did they do there?
Deposits look strong. Total deposits were up 14.1% year on year, reaching $27,147 billion.
And average deposits. Sometimes that gives a better picture.
Even better growth there, actually. Average deposits up 15.8% year on year.
Wow. What's driving that?
Seems to be a combination of expanding their distribution network, more branches, more reach, and just focused customer outreach,
Yeah.
building that deposit base.
Which is crucial for funding, right?
Yeah,
Especially with that lower reliance on borrowing we talked about.
exactly. Now, related to deposits, the SAYS ratio, current account, savings account, always a key metric for low-cost funds.
Right. How did that look?
It stood at 34.8% at the end of March.
34.8%. Is that up or down?
They noted an adverse variance, so a bit of a dip, mainly because customers are, opting more for time deposits to get higher rates.
Makes sense in the current environment. But did that hurt their overall cost of funds?
Apparently not too much. They managed it by being selective with their retail deposit pricing, so strategic pricing helped offset that shift in preference.
Okay, clever management there. Next up, a really crucial one. Asset quality. NPAs.
Asset quality looks, well, stable. The gross NPA ratio was 1.33%.
And ex-agriculture. Sometimes they give that figure too.
Yeah, excluding agriculture, it was lower, 1.13%. And the net NPA ratio, that's after provisions.
Right, the more telling number to
Well, it was quite low, 0.43%. So still looking very healthy on the quality front.
Good to hear. What about efficiency? Cost-to-income ratio.
That actually improved, came down to 39.8% for the quarter.
Lower is better there, suggesting improved efficiency.
Exactly. And finally, on the standalone numbers, capitalization, CRR.
Capital adequacy ratio remains strong, 19.6% overall.
And the core capital. Tier 1 and CET1?
Also very strong. Tier 1 was 17.7%, and the CET1 ratio was 17.2%, well above regulatory requirements.
So yeah, summing up the standalone bank, steady growth, stable margins despite shifts, strong deposits, good asset quality, better efficiency, and robust capital. Pretty solid picture.
Definitely sounds like it. Now, let's quickly touch on the consolidated figures, which include their subsidiaries.
Like the whole group view. Net revenue on a consolidated basis was $732.8 billion.
And profit.
Consolidated PT was $188.3 billion. That's up 6.9% year-on-year.
But again, maybe some adjustments needed.
Yeah, they mentioned an adjusted PT growth figure around 10% year-on-year.
Okay. And EPS, earnings per share.
24.6 for the quarter on a consolidated basis.
Wow.
And the total balance sheet size for the group, pretty massive. It only made $39,102 billion.
Huge. So overall, the consolidated picture reinforces that strength. What were the main things driving this performance across the board?
Well, we touched on a few already. That robust deposit growth, 14.1% year-on-year, was key, driven by their network and customer focus.
And the stable N we discussed.
Yep. Effective cost management, stable yields. Then there's the resilient asset quality that consistent focus pays off.
Plus the improving efficiency.
Right. Prudent expense management leading to that lower cost-to-income ratio.
And it wasn't just the bank itself, right? The subsidiaries chipped in.
Oh, yeah, definitely. HDFC Life saw PID-T growth of nearly 16%. HDFC AMC, the asset manager, up 18%. HDB Financial Services had strong loan growth, 18.5%.
Any weaker spots among subsidiaries?
HDFC Securities, the brokerage arm, did report a decline in net profit, so not uniformly positive, but mostly strong contributions.
And the broader economy helped too, presumably.
Absolutely. The positive Indian economic environment, consumer demand, exports, government spending provided a supportive backdrop, and expectations around RBI actions on liquidity and rates probably helped sentiment too.
So a mix of internal execution and external factors.
Got it.
Now, when analysts got to ask questions on the earnings call, what were they digging into? What was on their minds?
They were really focused on a few key things. The NII expansion or lack thereof was definitely one.
Understandable, given that stability we talked about. What else?
Deposit growth guidance, definitely. Where does the bank see that heading? Also, those CD ratio targets, how quickly can they get back to pre-merger levels?
And performance in specific loan segments.
Yes, particularly corporate loans, given the slowdown there, and also unsecured lending, always an area of interest.
So questions were likely around, how rate cuts might impact NM, how they plan to keep deposit flowing in without just hiking rates.
Exactly. And the outlook for credit growth overall, plus asset quality trends. Oh, and the HDB Financial Services IPO, that was definitely a hot topic.
Right, the upcoming IPO.
Yeah.
Lots for management to address. So let's get into those management insights from the call. Starting with NM, how did they explain that narrow range?
They basically confirmed what the numbers showed. NM stayed between 3.4% and 3.5%. They said stable funding costs, helped by less borrowing, were offset somewhat by that customer preference for time deposits.
And yields were stable too.
Yield on assets, also stable. They really stressed their focus on selective loan growth. prioritizing quality and getting the right price, especially in corporate lending, where competition from PSUs has driven spreads really low.
So they're willing to sacrifice some volume for better pricing and quality.
Seems to be the strategy. They did mention a couple of small tailwinds for NII in Q4 specifically.
Oh yeah, what were those?
A change in the cash reserve ratio, CRR, had a slight positive impact, and lower agricultural NPAs in Q4 also helped a bit.
And looking forward, regarding potential rate cuts.
They acknowledged that policy rate cuts would likely hit asset yields faster than deposit rates could adjust downwards, so potential for some near-term pressure.
But they're thinking long-term.
Yeah, they emphasized a long-term view on managing margins stably.
Okay. What about their strategy for growing deposits if they're not competing purely on rate?
Their plan hinges on distribution reach using their network, plus acquiring new customers and engaging better with existing ones through their relationship management system, RMS.
So, banking on the franchise strength, basically.
Pretty much. They sounded confident they could keep deposit growth coming without just throwing money at it.
All right. And the loan growth outlook. After that deliberate slowdown in FY25.
They basically said FY25 was about positioning the balance sheet. For FY26, the current year, they expect to grow pretty much in line with the overall market.
And beyond that.
The goal for FY27 is to actually grow faster than the market, aiming to recapture or gain market share.
But always with that focus on quality and pricing.
That was the clear message. Quality and appropriate pricing remain the priorities over just chasing volume.
Makes sense. Now, that CD ratio target, getting back to pre-merger levels, what was the timeline?
They're aiming for that 85% to 90% range, but they expect it might take until sometime in FY27 to get there.
So not an immediate return. And the faster reduction last year was just a side effect of slower loan growth.
Exactly. Slower loan growth mathematically helps bring down the CD ratio faster, assuming deposits are still growing well.
Okay. And asset quality outlook. They sound confident now, but going forward.
They reiterated the stability they've seen. They also sort of suggested that maybe the credit cycle for the whole industry has bottomed out.
Meaning NPAs might start to rise, but maybe not dramatically.
Yeah, their expectation is that NPAs and credit costs will likely normalize, but probably at a lower level than we've seen in past cycles.
And HDFC Bank's own approach.
Stick to their knitting, basically. Maintain current credit policies, focus on the total banking relationship, not just pushing loans.
Right. Now, that HDB Financial Services IPO,
Yeah.
any updates on timing?
Well, they confirmed the draft papers, DRHP, were filed back in late October. Now it's just waiting for regulatory approvals.
Is there a deadline?
Yes. RBI regulations require the listing to happen by September 2025. So the clock is ticking.
Okay, something to watch. We mentioned the corporate loan book shrinking. Why exactly did they say that happened?
Purely down to their focus on pricing and quality in the face of, as they put it, intense competition driving down returns.
So they stepped back where the pricing didn't make sense.
Essentially, yes. They expect rationality to return eventually, which will create opportunities again. And in the meantime, they're keeping those corporate relationships warm through other banking services.
Okay. Lastly, mortgages. Usually stronghold for HDFC. What's happening there?
Interesting dynamics. They mentioned lower available housing inventory, particularly in the middle to lower segments.
And affordability issues.
Yeah, past inflation impacting affordability, dampening demand in those segments.
What about the higher end?
There, the issue is intense price competition. And because HDFC Bank is sticking to its price discipline...
They're doing fewer loans there.
Exactly. Lower disbursements because they're not willing to chase business at any price.
So across the board, it really sounds like a theme of deliberate, quality-focused, perhaps more cautious growth right now.
I think that sums it up well. A focus on stability, profitability, and long-term positioning, rather than just chasing short-term volume gains.
Which leads us nicely to maybe a final thought for our listeners to chew on.
Go for it.
Well, given this clear strategy, aiming for long-term market share but prioritizing quality over sheer speed, especially now, how do you think this positions them?
You mean, how might this approach fare against future bumps in the road? Economic headwinds, competitive shifts.
Exactly. Could this current prudence, this focus on quality and margins, actually set them up for outperformance down the line, even if it means growth looks a bit more moderate today?
That's the million-dollar question, isn't it? Is patience now the key to winning later? Definitely something to ponder.
Indeed. So that wraps up our deep dive into HDFC Bank's latest results. We've gone through the key numbers, the management commentary, the broader context.
Hopefully, it's given everyone a clearer, more insightful picture of what's going on with the bank.
We hope so. As always, we definitely encourage you to check out the source materials yourself and see how these insights fit your own view. What stood out most to you? What questions do you still have?
Yeah, the conversation doesn't end here. Thanks for tuning in.